Rick Berube here. We are live again on Facebook. We are here with the lovely Leiestra Henson. Okay. I was going to comment about her wearing green for the Celtic last night. Very good job. She is not a Celtics fan. I am. All right, we're here for Prosperity Mortgage, of course.
Yes.
All right. So tell me a little about yourself. How long you've been? We were just actually talking that her daughter's 9. I've been here about 9 years, and she's like, "Seems like you've been here a lot longer." And I go, "Yeah, a lot of people tell me that."
Like, it seems like it's been longer.
That's just the beginning of time.
You've made it around so many places and have touched so many lives.
Oh, well, thank you. Wow, she turned that right around on me. All right, tell me about yourself.
So, gosh, first off, thank you so much, Rick. Rick is amazing, and I'm so honored to be sitting next to you with all of this energy and things like that. I'm excited to be here. Leiestra Henson, Prosperity Home Mortgage. A little bit about myself real quick. I'm originally from Arizona, was relocated to Las Vegas upon graduating from Arizona State University. First job, corporate relo, completely different industry, and I was at 23. I was 23 years old when I first moved to Las Vegas.
Dangerous age to move to Las Vegas, right?
Right. My dad was nervous. He was nervous. He's no longer with us now, but I remember he was extremely nervous.
I can only imagine.
I was a 23-year-old, just green, not a lot of knowledge about Las Vegas, let's just say that. But anyway, I survived and worked for that company and left a little bit momentarily, but then came back in 2000. So I've been here for 23 years.
Wow.
Another stretch. So started off in lending in 2001 with a major financial institution, opened up, actually it was a small subprime branch. We sold mortgage loans at 110% loan to value, 9-10%.
Wow. So you're part of the problem, right?
Probably.
Yeah. 2007, they crashed. It's funny you say that because now with some of these new programs, people are starting to say, this is kind of like a sub, but it's nothing like that.
It's nothing like that, completely different. So had fun with that, developed a team, opened a real estate development branch, transitioned over so did that for a few years. Then I decided, like everyone else, I want flexibility. So then I picked up my real estate license in 2010 and have been with Berkshire. Well, then we were Prudential Americana Group Realtors. And so I did that and then said, gosh, let me go ahead and sharpen my lending skills again. And so got back into lending a few years. So really, for me, I've been in lending and real estate in Las Vegas for over 23 years.
That's awesome. Awesome stuff. Yeah, and if anybody, just because we made that comment about 2007 and 8, if you ever want to see what actually happened versus what is going on now, simply watch a movie called The Big Short.
Yes.
That is
that was
scarily.
It makes you,
It's dramatized a little bit, but it's relatively accurate as to what's going on back then, which is nothing like what's going on right now.
Nothing.
Right, so right now we have a tight inventory market, but properties are selling. You take a listing today, it sells at a good price.
Yeah.
The trick right now, and it's not really a trick because historically the rates are still good, but I'm sure you're hearing a lot about the rates and the prime. It just went up again, 0.25.
You did, yeah. He just raised it 1/4 point, and
Sure.
so a lot of different sides, different opinions about that. Like what's going on? Banks are failing, rates are going. Come on now. But that is the reality that we're living in right now, right? And ironically and typically, when rates go up, Fed fund rates and things like that go up. Sometimes the mortgage will respond in a different way, and that is what we're experiencing so far. So luckily, we are actually still in a downtrend. As of today and as of right now, the 10-year Treasury bond is trading at 3.33. So 3 weeks ago, it was above 3.5. So we're kind of trending down, and we're actually optimistic for interest rates. May 10th is when the next CPI report comes out.
Right.
And so when that happens, we're believing that we're going to get some rate relief that'll take us into the summer months. So when I say rate relief, crystal ball, I don't know, maybe 5s. But as of today, FHA, par pricing, par means no points paid, about 6 3/4. If you buy down, say a point, you can get an FHA. It's a little under 5, maybe 6%. Conventional, 7%, but with the buy down, 6.3. VA, we love our veterans. VA, we price very aggressively. So VA, par pricing 6.25, but with the buy down, 5.5. The other popular tool right now, we got to kind of wait and see how the market or inventory continues to adjust or be tight, because when inventory is tight, that means bidding wars for buyers, right? Mm-hmm. So, but a very popular tool that we're using is the temporary 2-1 rate buy down.
Yeah, 2-1 buy down, like that.
So the reason why I bring that up is, so for a veteran, if we get money from the seller, and here's why I love what I do and why I like, because I know both sides, meaning the real estate, the contract, and the lending side. So I love strategizing with the realtors that I work with, and to come up with a way to how we can write the most strategic competitive offer. So if we get a certain amount of funds, depending on whatever that number is, and I tell them what it is, we essentially can, the seller, honestly, the net is not that much. Most sellers, if they are okay with paying for a buyer to buy their home and close in less than 3 weeks, right? With myself and Prosperity Home Mortgage. Little plug.
I like that.
But it doesn't. So VA 5.5%, get it down to 3.5%. There's your 3.5% loan, right? So 3.5% the first year, 4.5% the second. Locks out at 5.5. It's still a fully amortized fixed rate loan, and if they refi, it gets credited. No harm, no foul. I mean, it's
it gets credited, meaning the money they put on the sidelines to make the additional payment.
Absolutely.
Like if you would refinance in like 9 months, you still have
some money in your
15 months
account.
worth of right. So they just take down the principal, right?
You got it. So that's applied. So
that's really cool, actually.
Anytime you refi, it's going to be applied to the balance that will be refied. So it's a win-win situation. Honestly, the seller can get their money in less than a month if need be, and the buyer can have a little bit of payment relief with still security and it not being an adjustable rate mortgage. And then here at Prosperity Home Mortgage, if you work with us, we are refinancing mortgages. We're given a certificate at close. And so we'll say, hey, if the rates just like totally continue to decrease and it's favorable for you to refinance, we won't charge you a loan origination fee. And we're offering that for the next 2 years, so to 2025. Streamline refinance. You'll still have title, which is not our control, but the loan origination is $1,299 as of today. So that's awesome. A $1,300 essentially.
And we know the rates are going to come down eventually, but even so, okay, we know the rates will come down. I mean, will we ever hit the 3s again? Who knows? Yeah. Probably not. That's what I was telling everybody. Yeah. Like when this was happening, anything you own refinance, because this is not going to last forever. Right. And back to the banks, when they keep raising the base rate, which has something to do with mortgages, but not totally. Like you say, the Treasury bond has more. It's kind of exposing those banks that are in trouble. That's what's happening.
I was going to say.
And that's why you would think they would say, okay, we've raised that base rate historic amounts in the last 18 months. We should slow it down. But they keep Warren Buffett, Uncle Warren, as they call him. He says, who's skinny dipping when the tide goes up, and that's what's happening right now. Right?
Who's skinny dipping?
Exactly. These banks that are skimming, or you know what I'm saying, right?
I know what you're saying. Listen, comedy 101.
Exactly. Got to make it fun. So, all right, and you must be hearing, okay, so it's being called all kinds of things. Okay. But my favorite is the good credit penalty.
Yes, let's talk about that. Oh my goodness.
I've heard it called other things, I can't really say them here. But.
Yeah, so here's the deal, okay. So what took in effect, what it's called is LLPA. LLPA stands for Loan Level Price Adjustments or Adjusters, depending on who you're talking to. So every mortgage loan from the history of time always has back-end pricing adjustments, pricing adjustments. And some of those factors will be FICO score, LTV, geographical area, debt to income ratio, loan amount, loan size, things like that. So what has happened, and this actually took effect with most lenders in terms of pricing a few months ago. Okay, and so it's just that of effective May 1st, loans that are delivered to Fannie Mae and Freddie Mac, those have to include the adjustments, if you will. And so what we have found when you look at the chart, there is an increase, the largest increase kind of levels around someone with a higher score, above 700, 720, 740, with maybe 15 to 20% down-ish. And so there were adjustments all across the board, but that kind of stood out. And so what it appears as though if you have great credit, then you are being penalized for having capital, having money to put down, and great credit. And so there's controversy regarding that because, lending is it's risk-based pricing. And so the better the credit, right, the better the rate. The lower the credit, you're a little bit of a higher risk, so you might pay fees.
Right.
So anyway, to make a long story short, the reality is please know it is very beneficial to have great credit because the great credit loan application profile will still likely pay lesser fees than the person who doesn't have great credit.
Right.
So I want to politically present it that way, if you will.
Right, and I say allegedly, but it's supposed to be to help the people with lower credit and so forth, the additional fees and so forth.
It is. People with lower credit challenges, which, interesting you bring up that point. FHA has reduced their fees, their mortgage pricing fees, or you did that and you threw me off. Why did you do that?
Well, that's what because it looks like they're taking from here and bringing down to the 680 or lower.
Your body language threw me off.
Oh, sorry.
So, so FHA and VA. So anyway, they lowered their funding fee. That's what I'm trying to say. Right. Funding fee and monthly MI fee to make it a bit affordable for an individual who may need to be placed into an FHA product, right? So there's a lot of things across the board with the initiative of making homes more affordable for a larger group of citizens who would like to purchase a home.
Right, and that's the argument because most of those people that would use it are going to go to FHA anyway. Yeah. So it's really just getting the people that can afford it. Anyway, that's what it looks like. But
so FHA, I
think FHA is excellent.
I think so now. I'm flipping my opinion about FHA. Is that okay?
You can flip.
Here's the deal. Here's the deal. In some days, FHA pricing is actually better than conventional. When you're looking at a conventional 3% down first time home buyer program and 3.5% down. FHA generally it's a government loan. FHA, VA, USDA, those are government loans. So we can price those a little bit more aggressively, if you will. So it's really comparing apples to apples, which is what I like to do for every one of my buyers. Okay, should we go 3% or should we go 3.5%? Because the monthly insurance has been reduced, that now the payment may be lower interest rate. Now, the closing cost may still be higher because you have that 1.75% upcharge on an FHA loan. So here's the deal, like with anything, when we sell to people, it's what's most important to them, right? Yep. So if someone is a little shy closing funds, but they have a lot of room on their debt to income ratio, maybe the 3% conventional, because they're going to pay less up front, do you follow me, as opposed to more with the FHA and vice versa. Right. So it just depends.
And the key is, if you don't own and most of these loans are for first-time buyers, and so if you don't own your own postage stamp of the planet, a little lot, you should, however you can get in, is the way to do it. Right?
Exactly. Like, why wait? Yeah. Seriously, John Ingram, let me pull his name, let me plug
I know John.
Do you know John?
We went to different schools together.
Oh, nice. He's our mortgage brain guy here. No, but basically, he's come up with 3 categories that we, ask borrowers. Because here, listen, we're not here to force you to buy a home if you, in your mind, are not comfortable. And let's be real, there are a lot of things going on in the industry, in the market right now, and every family is going to have a different circumstance. So if someone is financially secure, and what we mean by that is, what is your source of income? Are you comfortable with your job? Do you think there's going to be some downsizing in your job? Do you have a savings account? After you put down payment and closing costs, will you have
Reserves.
money set aside? Reserves,
Yeah.
exactly. How long do you plan to stay in the home? Is this a 3 to 5 year? Are you trying to flip it? No. Real estate's always been a long-term investment. So 3 to 5 years or longer. We sit down and we talk about that. Do you have any upcoming changes in your family life? Are you having a baby? Are you wanting to downsize, go from a single story to a 2-story? So there's a lot of different motivational factors that's going to apply to different families, right?
Yeah.
So, but if you're just like, I'm going to play double dutch and I'm going to wait till when the rate's at 3% and where I can buy a home for $150,000, it's not going to happen.
Right. Double Dutch, huh?
Yeah. That's my vision, because you know how, and you're like waiting to get in, these ropes are going, and you're like, okay, I'm getting ready.
Yeah.
Don't do it. Don't do that. No, specifically, don't. See, real estate is you buy and then wait. You don't wait to buy.
Right. Good point. And if you jump in at the wrong time, you could get clotheslined.
Well, you just have to
You know
hold
what I mean?
tight. No, I don't know what that is, but I'm just in the same.
Jump and rope.
Oh!
You know what I mean? Hit you.
Oh, and then
Double Dutch. Come on. There's
Buy-
2 of them.
right. Buy, wait, create a solid foundation. I'm ignoring him. I can do that well
Yeah, exactly.
because
It's a
no,
skill.
I'm not going to say that.
Right. Well, anyway, my point is, the thing is that, and that's the great thing about, for me as a real estate agent, I'm also, I'm the VP of sales for the company, but I'm also a licensed agent. I like to use, Prosperity is part of it's part of Berkshire Hathaway. Plus, not only that, they have several programs.
Yes.
Like where you had been before, where it's a little more stiffer with those big banks, you don't have the room you can move around to get you into the house.
Is that what the banks are?
Yeah.
You said it.
Big and stiff, yeah, not bad.
Okay.
Not bad.
Yeah,
They don't have as
That's
much,
right.
much flexibility.
It's true. No, I absolutely love being on Prosperity side. It's been an eye-opening experience for me because I can do so much to help so many more people.
That's
And so not only are we a broker, we can broker loans. Primarily, we offer delegated loans and loans that are available through many investors. So lots of DSCR. Oh my gosh, I could go on and on and on. Bank statement programs. DSCR are basically debt service loans for an investor. You own up to 10 properties. You don't give me any tax returns. Don't give me any bank statements. Let's just figure out what your mortgage payment's going to be. So we're going to take the rents for the area divided by the mortgage payment to come up with a ratio. I-10s, people who don't have traditional Social Security numbers, but they're working here legally in the United States. Foreign nationals, they are not a citizen, not working here, but in town to purchase a home. We can offer those solutions as well. The sky's the limit. I absolutely love it. And so with that, I also have different investors that I can put pricing on, meaning different companies. I won't name the companies. Our jumbo products, we work with different banks, large banks, and credit unions that I can put pricing on.
Cool.
So and we offer 3%, as little as 3% down on a jumbo loan. Can you believe that?
I know, it's crazy.
So
Jumbo starts at what? What's the loan amount?
I was just about to say, so conventional conforming for our area, Las Vegas, is $726,200. Okay, so anything above that, so $727,000. So you can buy, let's just call it $750,000 home with 3% down here in Las Vegas.
That's crazy. Yeah, I remember when I was smiling because I remember when I started in the business, jumbo loan started at like $275.
Whatever.
39 years ago.
I was going to say, when was that?
39 years ago, yeah. That's how long I've been doing this, since I was 12.
I see. That's
exactly.
good.
That's not that funny, Lisa. All right, so anyway, my point is, here we go. So, here's the thing about today's market. The inventory is tight. When I started the business, you used to hear this all the time. It's the American dream, owning your own, I call it the postage stamp of the planet, but owning your own piece of real estate and so forth. And another term I used to hear all the time is, they're only making so much land. With the amount of new construction that's happened in the last 15 years versus any other time in the history of real estate, meaning we are at really a housing shortage that's going to become more and more evident. So if I'm somebody today who needs to own my own postage stamp, I'm going to get out there, I'm going to buy one today, even though the rates are a little higher than they were before. Historically, they're still very good. We were spoiled for a while. Okay, hopefully we'll be spoiled again. right? So get out there and because as soon as the rates start to change, and like Leiestra's saying, towards the end of the summer, we got an election year coming. They're not going to leave these rates like this for long. It's going to be all these people on the sidelines or waiting to get in double dutch.
Double dutching.
Right, was he saying that?
Yeah.
All right, I'm going to jump in and hopefully I don't get closed, Mike. And okay, it's going to create a feeding frenzy again, which I can see down the road coming in my crystal ball.
Yeah.
So my point is that it's a good time. It's like an eye of the storm right now. Even though it's still moving along well, it's a good time for you to get out there and make that move, I think.
Yeah.
Okay. And,
absolutely. I absolutely do. And the only way you'll know is pick up the phone, call me, talk to your realtor. Let's put together a game plan, because you never know. Speaking of game plans,
let's hear it.
Here's another prosperity, what we are doing to offer our clients. So let's say, okay, but I'm a homeowner and I want to buy, but I need the equity in the house, but I don't want to move twice, and I don't want to do. Okay, great. So we have a bridge loan product. Now, bridge loan is not. That is, there are some lenders that offer it. Okay, get it. But with us, we offer bridge loans to our customers that we will be holding the mortgage to, right? Mm-hmm. So if you live in a home and you want to go ahead and advance the cash before and write a non-contingent offer, which is even more important in today's market with lower inventory, right, higher demand. So you want your offer to be competitive. You don't want to write an offer contingent upon the sale of your home. We'll go ahead. We'll process a bridge loan. We'll forward you the money. It's a 6-month loan. Must be Uncle Warren's money or something.
Must be Warren.
But it's like a 6-month loan at 8.5% or whatever it is. It may change, but like interest only. 6.5 months, right? We'll loan you up to 80%, and independent on the loan file. You have to have some reserves and things like that. But we'll let you cash out, right? To buy, use that money, whatever that money is, so that you have an ample amount of down payment to put on your new home, as long as you qualify for both mortgages, and the reserves will do that for you. So we'll bridge that. You don't have to move twice. You don't have to sell your home. You don't have to write a contingent offer. Once you sell your home, then you pay the loan back. You're already in your new home and things like that.
Great. So not everybody's doing those.
Yeah. So we kind of, I don't want to say control, but we like to strategically manage both files. So that's why we offer that on the mortgages that we carry.
All right. Well, and make sure you're pre-qualified by Leiestra before you go out. That's the key, and they have a lot of great ways to do that too for you guys. So your offer is taken way more seriously than the other person. So there you go. Anything else you want to add to these lovely people today?
Oh my gosh, I just always, let me see.
Anything you forgot?
I know I made notes because you got
like 3 pages of notes there.
Because I didn't want you to hit me with a rocket science question.
No, you were great.
No, it's all
right, everybody. Well, thank you. Thank you for your time today. Really appreciate it.